Welcome back. Chapter 3, the lease option and the lease purchase contract. The lease option and the lease purchase contract. I call this the foundation. The reason why I start out the video series with the lease option and the lease purchase contract is because I firmly believe that understanding the lease option and the lease purchase, even if you don't use it, is the basis for the foundation that you need to be able to understand all the rest of the alternative purchase and sales options far better than you would without understanding the lease option and the lease purchase contract. So let's talk about the differences right off the bat. First of all, the lease option contract and the lease purchase contract are really only different in one way. The lease option contract gives the seller the obligation to sell at a certain point in the future, and the buyer the option to buy. It's their choice. The lease purchase contract gives the seller the obligation to sell, and it also gives the buyer the contractual obligation to buy. That's really the only difference between the lease option contract and the lease purchase contract. So we're going to talk about the lease option contract. There's lots of reasons why you might use a lease purchase contract, but understand the only difference is that it gives the buyer the obligation to purchase versus the option. So we're going to talk about the lease option contract. There are two closings in a lease option. Two closings in a lease purchase, and that is when the lease option agreement, the sales contract, the seller financing addendum, all the disclosures, the escrow instructions are signed, title is purchased, escrow is opened, and escrow closes. And then sometime in the future, could be any time, could be a 3-year lease option, a 5-year lease option, a 10-year lease option. I don't recommend less than 3 unless you're trying to deceive or take advantage of someone, because you want the buyer to have the ability to qualify for a loan if that's what their intent is in the future. So sometime in the future, it could be a 100-year lease option. Doesn't matter, okay? It's all available and it's all legal. Now the reality is, two closings. So when they do exercise their option prior to their option period ending, they're going to exercise their option. They're going to go to the same escrow company if it still exists, and they get and buy this title insurance again, potentially from the same title insurance company. They're going to open escrow and they're going to close escrow again. There'll be a whole new set of escrow instructions created from the same first contract that happened months or years prior, and you're going to open escrow and close escrow again. So understand that there are two closings. Another term for lease options or lease purchase contracts is buying subject to existing financing. Another term for lease options and lease purchase contracts is seller financing, no bank needed. Another thing to understand is that title does not transfer during the lease option period. It only transfers when the seller or the buyer exercises their option in the future. So there is no default or due on sales clause or anything like that. We'll talk about that in the future when we get to AITDs. Control of real estate, controlling interests of real estate has, however, in fact, transferred. Let me be very clear with you on this. I believe it was said first by the Rothschilds, but it was also echoed by Warren Buffett, and that was this term: I don't want to own anything. Well, what I want to do is control everything. And so when you understand it's the control of real estate that builds wealth in this country more than anything else, not the ownership, then it starts to put all the pieces of the puzzle together. Here's another understanding key that you need to understand as we get into this section. When is your modest profit earned? Whether you're a real estate investor or a real estate agent, when is your modest profit earned? At the beginning, when they have the negotiation and when they come together with the seller and the buyer needs somebody to find the seller needs somebody to find the buyer. At the beginning, when they're going into escrow, they're going to get the appraisal done if they're going to have an appraisal, the title insurance is going to be done, or 5 years later when the buyer exercises their option. When is your modest profit earned? It's earned at the beginning. It's earned at the beginning. So when the problem was solved is when it was earned. So where in the world did real estate agents get the idea that they don't get paid the commission till the buyer exercises their option? It was never intended to do that. They get a full real estate sales commission at the beginning, at the signing of the lease lease option agreement. And that's really important to understand. I mean, when do you want to get paid? 5 years later or now? Why would you get paid a lease agreement commission or a rental commission now and a sales commission later? Why would you do that? You're on the hook now. If you're a real estate agent, you have liabilities now. As a real estate investor, you have liabilities now. We all have liabilities. Agents just have E&O insurance and investors don't. So bottom line is, you've got the responsibility, liability, and the risks right now. You should be getting paid right now. Understand that as an understanding key. Let's look at the benefits to the buyer and/or the investor in a lease option. First of all, control of real estate without title. Control of real estate without title. That can be a huge benefit to an investor. And yes, if you're an investor thinking you don't want to take lease options, you're absolutely wrong. I'll introduce you to somebody later that made a lot of money buying and selling using lease options. Control of real estate without title. That can be very valuable. Maybe you're in a divorce, maybe you're in a situation, doesn't make any bankruptcy, foreclosure. Very little down payment necessary in a lease option purchase contract. How much down payment? Typically, however much you want to make in modest profit. If you're a real estate agent, you're probably looking at about 6%. If you're a real estate investor, you might be looking at the same, 6, maybe 10%. But whatever you want to make in your modest profit is going to come from the down payment from the buyer. Now, let me be frank with you. There is no limit to the amount of buyers out there that have a down payment. Heck, some of these people haven't made a payment in the home they're living in for 3 years. They have a down payment. So there's no limit to the amount of people that have a down payment. There might be a limit in your communication skills to help them feel comfortable about giving a down payment, but what's the difference between that and a traditional, lease option purchase contracts and a traditional mortgage when it comes to understanding the importance of putting a down payment down to transfer title or transfer interest, controlling interest, okay? Jumbo loan, no problem. Doesn't make any difference how big the property is. It doesn't matter if it's residential or commercial. It doesn't matter if it's $100,000, $1 million, or $10 million. It's the same program. It's the same process. Payment could be significantly better than in a mortgage. That can be very true, especially in the higher sales prices and in the commercial properties. If you compare what the lease option payment is needed and required for by the seller versus what a mortgage loan would be with possibly private mortgage insurance, a higher interest rate, or even whatever, you often can find a much better deal as far as a monthly payment in a lease option payment versus a mortgage payment. Bad credit, but has the capacity. So it doesn't matter what your credit is. Again, we're not trying to take advantage of people. We do need to be responsible. That's what caused this run up in the first place. People buying homes that had no business buying homes because there's no way they could have covered the payment once it adjusted. So understand that you want to make sure your buyers have the capacity to make a payment, but the credit has nothing to do with this process. It's an option to buy, not an absolute. An option to buy, not an absolute. Why is that a benefit to the buyer? Well, let me ask you a question. How many people do you know who bought a home in 2006 today wished they would have bought that home on a lease option? I think you would agree that every daggum one of them, 100% of them, there's another absolute, but every single person who bought a home in 2006, probably in this entire nation, wished they would have bought it on a lease option. Instead of losing $300,000, they would have lost $30,000. But nevertheless, that's a great option. If it's time to exercise their option and the value has gone up, they're stepping into equity. If it's time to exercise their option and the value has gone down, they have the same options as they would have if they bought the home on a traditional mortgage lender transaction. What do I mean by that? They don't have to lose their down payment. They can choose to continue to make the payment and extend their option. They don't have to lose their down payment. They can walk away if they want. They don't get their down payment back because it's a down payment, not a deposit. But if they walk away in a mortgage transaction, do they get their down payment back? Of course not. But they have the same options. If the value has gone down, they can continue to make payments, or they can walk away if they want to. They have the same options as somebody with a traditional mortgage finance loan. First right of refusal is important to have for a buyer. So if the value does go down and the seller still wants to sell, but the buyer's not willing to buy at the price that they had agreed on prior and they have an option not to buy, but then the seller still wants to sell, the seller has to offer it to that buyer for the same price that they're willing to sell it to somebody else for. And that's the first right of refusal. So that's a way to benefit your clients, as also protect your buyers. Can sublet if necessary. Obviously you want the buyer to have the ability to sublet. Because what if they lose their job? If they lose their job and can't make that payment, which is another question will come up later, they have the same options if they have a subleasing capability inside their lease option agreement that they would have if they bought the home on a traditional mortgage. If they bought the home on a traditional mortgage and they lost their job and they couldn't make their payments, they don't have to lose their house, lose their down payment, lose their credit. They can actually go rent a one-bedroom studio apartment for them and their family and lease this house out and keep the contract in place and keep their credit clean. Well, why don't you want that same option as a lease option agreement? If I lose my ability to make a payment, I can go rent another house for my family and release this house for enough to make that underlying payment, so I keep the contract in place, I don't lose my down payment, and I don't lose my equity in my house. Because remember, the equity belongs to the buyer until the option period expires. Very low closing costs. As a matter of fact, what's the biggest closing costs associated with a mortgage transaction today, a typical lender mortgage transaction? It's the loan. Whether it's being paid through the interest rate being raised in a no loan closing cost loan, or it's being paid up front by the buyer or the seller. Typically, the majority of the closing costs associated with a real estate transaction today is the underlying mortgage financing, and which is a real big reason why mortgage banks don't necessarily want you to know what I'm sharing with you today. In continuation of the benefits to the buyer and the investor, name's not on title. I call it security through obscurity. Now, I'm not a lawyer. I'll keep saying that all day today. I'm not a lawyer, so you want to talk to an attorney or a trust attorney possibly for the best way to protect your assets as an asset protection plan. But I feel that one of the very first steps in asset protection is to get your name off title. It's only my opinion, but I'm probably right. So being able to buy properties and not be on title. Maybe you're going through a divorce. Maybe you're going through a lawsuit. Maybe you're in the middle of a bankruptcy or foreclosure. You don't want necessarily to be on title. Lease option you're not on title at all, but your controlling interest can be in any entity that you want it to be in. I call it security through obscurity. Can record the option if it's done properly. Obviously, if you're a real estate agent, you want to make sure it's always being recorded. If you're using escrow and title, it's going to be recorded, although I've heard a couple of mistakes that title and escrow were making recently because it was so new to them. But title companies are ensuring all these concepts. In fact, I just heard Chicago Title, I believe, just recently revamped their entire all-inclusive trust deed division, so they're understanding that this is going to be ramping up in a very big way. So if you're using title and escrow, you should have everything recorded properly anyways, but you want to make sure as a real estate agent that it is in fact being recorded, as well as a real estate investor would want to know that. Interest can be willable to anyone. Now this is valuable. You have an asset here. This is not like renting. I like people say, oh, in lease options. Isn't that like renting? Isn't that like rent to own? Lease optioning has nothing to do with rent. The reason why they think that is because lease and rent are often interchangeable. But when leasing is connected to a lease option agreement, it has nothing to do with a rent. Lease option and rent has nothing to do with each other. Well, let me give you an explanation. The interest, controlling interest to the real estate that I go into a contract with is a willable controlling interest. Willable equity. What do I mean? I agree to purchase a house for $300,000 from a seller. And I go into escrow. And let's just say I have a 10-year lease option. 8 years from now, the house is worth $500,000 or $600,000. Let's example, it's gone up, it's doubled in value. 8 years from now, and I died. Well, if I didn't will that as an inheritable controlling interest to my heirs, in fact, if my heirs didn't even know that I had that lease agreement, what would happen to the monthly lease payment? It would stop. Well, if it stopped, what would happen to the controlling interest and the equity in that property? It would go back to the seller. Now, how is that different than if I bought a home on a traditional institutional lender mortgage? Well, if I put a big down payment and bought a home for $300,000 and 8 years later it's now worth $600,000 and I died, and my heirs didn't even know that I bought that house, didn't know about that mortgage, and my mortgage payments stopped to that lender, what would happen to the controlling interest of that real estate, and what would happen to the equity? It will go back to the bank. There's no difference between the lease option and the, for that matter, all the other types of alternative purchase options. There's no difference between them and a traditional mortgage lending transaction when you understand those considerations. It's the same thing. So understand that an interest can be willed. Controlling interest can be willed to another person. Possible benefits from lower property taxes. If I were to buy a house on the coast and I were to agree to with a seller that I was going to pay $5 million for this house, just as a crazy example, $5 million for this house, and the seller agreed for it and I was willing to pay for it, and but then I learned that the seller has had that house in their family for 60 years. Do I really want title to transfer? Obviously, no, not no, but hell no. I don't want title to transfer, because property taxes is going to not just triple, but go up maybe 600 or 700%. So understand, how long would I want my lease option for? Well, what's the limit? I don't believe, I'm not a lawyer, but I don't believe there's any limit to a lease option. So there's a really good thing for lease options, good reason for lease options, the possible property tax benefits, okay? Option to sell instead of buy. Let's go back to that other example. I bought that house for $300,000. 8 years later, it's worth $600,000. I didn't die, but I also don't want to continue to live there, and I don't want to buy the house. I want to buy another house. Maybe my job has moved me. I want to buy another house. Do I have to just let that house, the controlling interest, and the equity of that house go back to the seller? Absolutely not. I put it on the market. I hire a professional real estate agent, and I list the property and I sell it. But oh, Steve, you're not on title. You don't have to be on title. You have controlling interest to the property, and that's what your title insurance was for. You can list it with a real estate agent, sell it, and the seller, previous seller, has nothing to do with that transaction. When it pays off, the seller, your seller, the previous seller, is going to get their $300,000 or whatever you agreed to pay, and you're going to put the other $300,000 minus any real estate commission and costs in your pocket. What's that got to do with rent? It has nothing to do with rent. So get lease options and rent out of this, off the same page if you got that in your brain. The contract can include anything. This is really valuable too, because see, we've been doing things one way, one-sided for at least 15 years. We've been doing things one-sided with a real estate sales contract offer, and then the buyer getting a mortgage loan, traditional mortgage loan from a traditional mortgage lender, and closing escrow. But could you include the Corvette inside the garage in the sales price when there's a traditional mortgage lender involved? The answer is no. Of course you can't, because who won't let that happen? The lender won't let that happen. But you know from your real estate education and when you got your license, you can include anything in a contract, but the bank can determine what they will allow to be in the contract. So when you're dealing with alternative sales and purchase options, any of them for that matter, it doesn't matter what you include in the contract, because there's nobody telling you that you can't. So that can be huge, and we'll talk about that later. Contract could include the purchase. So this is valuable, and we'll pick this up later. The contract, a lease option contract, could include the purchase of the underlying loan, either through an assumption or through an all-inclusive trust deed. At the end of the contract, this could be massive, and we'll talk about the math on that later. And the best benefit to the buyer regarding lease options and all-inclusive trust, or all of the alternative purchase and sales options, but the best benefit is the fact to the buyer, the best benefit is that they get to play the game. Prior to understanding these concepts, because they couldn't get a loan, I can't tell you how many times I've talked to a client or someone out there and about who says, oh gee, I wish I could take advantage of today's real estate market. I always ask them the same thing. Well, why don't you? Well, because I don't qualify for a loan. That's what I hear most all the time, maybe 95% of the time, because they don't qualify for a mortgage. Well, as a real estate investor, James Smith taught me this, as a real estate investor, as well as a real estate agent, couldn't you ask the person, well, do you have a down payment? And if the answer to that question is yes, your statement can be very simple. I can help you buy a house and I can get you a great rate. And the reason why I say that is because the rate, interest rate on the underlying loan is often a great rate historically. Even in today's market, it's going to be likely a great rate. So understand that the buyer or the investor has the ability to play the game. Benefits to the seller. The benefits to the seller are massive too here. If you understand this, and a lot of real estate investors and agents think it's hard to get the seller to agree to these concepts. That is absolutely not true. It's called communication, legitimacy. It's called the law of attraction. Absolutely not true. Okay, here's the reality. Benefits to the seller. When the seller understands their benefits, it will overcome risk, it will overcome fear, it will overcome concern if they understand their benefits well enough. Biggest benefit they have is they can sell the house for a higher sales price. They can always sell the house for a higher sales price than they can with a traditional mortgage loan buyer. All right, we're not trying to deceive anybody here. If the buyer wants to know what it's worth and they want to get comps or get an appraisal, that is a good idea. We want legitimacy. We want to do this correctly. But you can always sell the house for a higher sales price with seller financing because that's valuable. There's a value happening there. Down payment can be considerably higher in a lease option down payment versus a rental deposit. If I rent a house to someone, then I can only legally get, because of the landlord-tenant rules, I can only legally get 2 months rent as a deposit. And it's a deposit, not a down payment. And if the house is furnished, I can get 3. But everybody knows that damage can far exceed 3 months worth of rental deposit. But as an investor or a homeowner that wants to sell a house on a lease option contract where I'm giving controlling interest of that house to a buyer, not to a renter, then I should be able to get something in return. I've given them something, I can get something in return. And one thing is going to be down payment. Additional down payment. One thing could be a higher monthly payment. One thing could be lack of required landlord-tenant relationships and repairs and upkeep. Okay, but talking about the down payment, if I'm selling a house to somebody on a lease option situation, maybe I have a house with a sign in the front yard saying buy owner financing, seller financing, no bank needed. Somebody calls on that sign. There's a toll-free number at the bottom. It's me with a recording telling them about the lease option and how I'm offering this house. They call me up and say, well, I looked at the house, I saw the sign, I listened to your recording, I'm interested in buying this house on a lease option. How much do you want for a lease option down payment? My answer is always the same. How much do you have? How much do you have? Because that's how much I probably want. Now, typically I'll ask for 10% or more, or 10% or less, but I can take more than that. I sold a property with a $300,000 lease option down payment. So understand that you can get a larger down payment. That protects the seller in a big way. Down payment is non-taxable or tax deferred. That's a better word for it. It's tax deferred. That down payment money is tax deferred until the year in which the buyer exercises their option or until the year in which the option expires. So that can be very, very valuable to a seller if you understand their tax implications of selling it on a traditional loan buyer. Now, that brings up another point. Today in the real estate industry, whether you're an investor or an agent, you need to understand that you have to know a little bit about everything. You have to have knowledge. You need to know about taxes and tax percentages and how much somebody's going to pay if they're going to get a lump sum of a certain amount based upon their tax percentage and what they make as far as a regular income. You need to be able to learn how to calculate that. None of that is difficult to do. I can help you with that. And we do that during the Fast Track series and also during the main event. No landlord or tenant relationship. This is a great benefit to the seller. Look, you know, they sign the lease agreement, they sign it at escrow or in front of an attorney in an attorney's office, and they are going to be told, they're going to sign a disclosure that states, look, don't call me. I'm not your landlord. Don't call me for repairs. I'm not going to fix your toilet. I'm not going to cut your grass. I'm not going to do anything. This is your house. Controlling interest has changed. It's not the same landlord-tenant situation or relationship, so you fix it. In fact, if the tornado rips your roof off and there's a amount of money that has to come out for the deductibility on an insurance policy, I'm not paying that. You are, because this is your house. This is not my house. So no landlord-tenant relationship. Income is more predictable and steady. So maybe I'm selling this house because I want the lease income for a long period of time, and I want it to be more predictable, more steady, less chance for eviction or vacancy possibilities because the buyer is putting more down than just 2 months deposit. Can get more money than rent, especially with rent credit. Now typically rent credit is used because the lease payment we're asking for from the buyer is considerably higher than the going rent. You can typically ask for more of a lease payment because you're controlling interest, but maybe it's even more than that. And we need enough money for the seller to make sure that going through the third-party trustee has enough money every month to pay the mortgage, pay the taxes, and pay the insurance. So that's typically why rent credit is used. It can also be used to pay commissions and for modest profit to an investor as well. But typically it's used to make sure that the underlying mortgage and taxes and insurance are going to be covered through the monthly payment by the buyer. But the buyer isn't losing all that money. Much of it is the rent credit is going towards their down payment. And the balance in the underlying loan is going down. So math-wise, it all works. Now, some reports show that 60% don't buy. Why is this a benefit to a seller? 60% of people who go into a lease option agreement don't actually exercise their option. Why is that a benefit? Well, obviously, as a seller, you get to sell it again. Do you have to give back your lease option down payment? No, it's a down payment, not a deposit. Do you have to give back the rent credits? No, you don't have to give back the rent credits. Now, it doesn't mean you can't. As a owner of a house, if a buyer called me and said, look, I lost my job, I'm going through this or that, I'm getting a divorce, and I'm not going to be able to continue making the payments. I understand that, I'm probably not going to get my lease option, my down payment back that I gave you. Is there anything we can do? I'm going to say absolutely yes. If you take care of the house, help me show the house, keep the house in perfect condition so that the new buyer moves in without me having to do anything, I'll give you half your down payment back. There's a lot of things you can do to, if you want to make things easier, to eliminate challenges and hassles, but you don't have to give those back. Those can be profit. Easier to qualify for new loans. So I said one of the things you can get a higher lease payment. Well, if I'm turning around as a seller and I'm going to go buy a house using a traditional mortgage, and when I go through underwriting, the underwriter is going to look at the house that I just sold because it's on a lease option, not on I haven't transferred title, so I'm still on title and the mortgage is still in my name. They see that on my credit report. They're going to say, okay, show me the rental agreement. Now I'm getting $2,900 a month. Versus the $2,000 that I might have been able to rent it for. And if the underwriter will only credit me for 75% of the rental income to offset my payments, is 75% of $2,900 better than 75% of $2,000. So it helps me qualify for buying with traditional mortgage loans easier and better. Faster closings, that can be a benefit to the seller. Sometimes the seller needs to move fast, and a 60-day escrow just isn't something that they have time to wait for. Contract can include anything. We talked about that before, but we didn't mention the fact that it could include anything with regards to the down payment. Why give cash? If the buyer has a Corvette or a buyer has an older RV and the seller wants that RV, or if the real estate agent wants that RV, or if the real estate investor wants that RV, why can't you get something of value in a down payment versus cash? This is huge. Again, if you understand all these concepts and start putting them together, you'll be walking into situations, putting together deals in your mind and making things happen before anybody knows what's happening. And you'll be able to put together a deal that solves the seller's problem, solves the buyer's problem like no one else can. So understanding even the down payment, even the commissions, even the modest profit for a real estate investor can be made or got through valuable items or consumer goods or goods. Another thing, a seller, banks can be a seller. A bank. They take back a lot of properties. They've got a lot of REO properties for one reason or another, which is a topic of another subject, that they're not selling those houses. Could a bank sell a house that owns a property, sell a house on a lease option? Absolutely they could. And there's going to be an example of that later on. REO property, buying an REO property from a bank on a lease option. But understand, when that happens, something very differently happens to the way the bank reports their assets and liabilities. Now, don't hold me to the exact wording here, but understand that the way the bank, how much money the bank can lend out is based upon how much money the bank has in assets and in liabilities. So when a bank accepts a lease option on an REO property, it changes that equation for them. I'm not going to go into that too much in detail right now, but it can be a big benefit to a bank. How about the benefits to the real estate agent? Well, that's pretty clear. Faster closings, more cash, no mortgage, no appraisal necessary. Now, I'm a mortgage lender. Most of the money I make in my life comes from my residential mortgage financing business as a certified mortgage planner. By the way, did I mention I do mortgage loans? And I'm looking for some great real estate partners out there. Give me a call. Love to help you. I think outside the box, that's pretty clear. Nevertheless, no appraisal necessary. We're not deceiving anybody, but it's not necessary. No sudden surprises with lenders or underwriting guidelines changing. No programs don't change overnight. No funding conditions. That can be very huge. I remember in 2008, I would come into the office several times throughout the year and I'd raise my hands and I'd ask, are we still in business? Somebody in the back of the room would say, yes, we are. And I'd say, okay, what are the rules today? Because bottom line is, things have changed so dramatically in the mortgage industry, and they really typically right now they're still changing, not so much as they did in 2008, but they're changing radically still. The Dodd-Frank rules are just coming into effect at the beginning of the year 2013. That is going to be a massive change in the real estate and mortgage industry. Understand that, okay? So no funding conditions, programs don't change overnight. More buyers and sellers, a better than 500% increase in your abilities as an agent or an investor. Doesn't matter, same people. More closings, of course. You can turn real estate faster, you can make more sales, you're going to make more deals. Make more money, easier closings, faster closings. Obviously, you can close these transactions typically in 10 days. Now, I recommend for the first 1 or 2 or 3 that you do, make it 30 days. Make sure you're doing it all right. Work with your escrow officer, work with your title rep, work with the third-party trustee. Make sure you've got it down so you've got it. You remember the first time you did a transaction, on a traditional transaction with a mortgage lender? The first time, whether you're an investor or an agent, the first time you did it, wasn't it difficult? It was different because it was different. It was difficult because it was different. And this is going to be the same way. Once you do 1 or 2 or 3, you will be an expert, more so than most people in the country. So understand, once you do a few, you will know what you're doing, and then it'll become much easier. There's more flexibility to structure deals, more reasons to show your value. Instead of cutting your commissions like a real estate whore, maybe I shouldn't say that on this video, but I really don't think real estate agents should cut their commissions. They take liability. They have a lot of responsibility. They earned their commission. Real estate agents should not cut their commissions. But if you can show to the buyer or to the seller your value, they won't ask you to cut your commissions. Well, one value is to a seller, hey, I'm selling your house for more money than what it's worth. How can a seller argue with you about what your commission is when you're selling their house for more money than what it's worth? So you want to show value rather than cut your commission. Okay? Less clients will use you. Far less clients will use you for information. Buyers, agents, as well as investors. Far less clients will use you for information than move on to another agent or another investor because they don't have the same options. For the benefits for the real estate investors, it's the same as the agent. They're the same people. Understand the real estate agent. The only difference between an agent and an investor is an agent has a license and an agent has E&O insurance. An investor has a higher liability because he doesn't have E&O insurance. However, an investor and an agent can be the same people in that world. Isn't America great? Ain't this country great? Now, the risks on a lease option, lease purchase contract, the risks are with the buyer. Now, when I say the risks, don't get all freaked out over this. It's not like there's huge risks here for the buyer or the seller. Understand that there are risks in renting out a house. There are risks in selling a house on a lease option. The risks when you sell a house on a lease option are far fewer for the seller than a landlord is when they rent out a house. That's absolutely true. Far fewer for the seller or landlord. However, there are 2 unique risks for the buyer on a lease option contract, lease purchase contract, over getting their own mortgage loan. And or maybe over an AITD, or maybe over a seller financing loan. And that is, the first risk is, what if, because it's a lease option, means you have to exercise your option sometime in the future to buy the house. So what does that mean you have to do? You have to qualify for a loan. That means, what if you don't qualify? That's a risk. I call it qualification risk. What if I don't qualify for a loan when my option is expiring? I could lose my down payment. That's true. There's a risk. There's a risk there. Okay. Also, you could also petition the seller to be able to extend your contract. But nevertheless, there's a risk. What if I don't qualify? Another risk is, well, what if I do qualify, but rates have gone way up? That's called interest rate risk. Investors understand interest rate risk really well. If they've got to assume that they've got to qualify for a mortgage in the future, they've got to hope that interest rates haven't gone way up. Could they go way up? Have they gone way up in the past? Sure, they could go way up. Maybe it's going to be 12% interest rate. Who wants to buy a house at 12% interest rate? So they have interest rate risk. But those are just unique risks, but really no different than any other risks associated with anything other than a 30-year fixed rate loan. And let's face it, the reason why they're doing this likely is because they don't qualify. Not the only reason why they would be doing this. Many investors buy this way even though they do qualify for a mortgage loan, and because there's good reasons to do that. There are no other unique risks to the buyer or to the seller regarding lease options and lease purchase contracts. So here are some of the questions that I get during this program. Again, I've done this presentation billions of times. Feels like billions of times over the last 7 years. Been in front of 10, maybe 20,000 different real estate agents sharing this, and I typically get some questions. I've answered all those questions, but I'm going to share those questions that I typically get. Who gets the tax deductions? Well, it's a lease option, so title has not transferred, so typically it does belong to the seller. That's a benefit to the seller, by the way. Another benefit that we didn't mention during the seller benefits is the tax deductions for depreciation can continue with them, likely continues with them. They wouldn't really need the tax deductions from the interest on the underlying loan because they also have to take the income from the lease payments. So they're doing that, but it's a wash. The benefit, real benefit to them is the depreciation benefit. So who gets the tax deduction? Somebody told me recently, I don't know if this is true. I don't think it is personally, but I have not confirmed it. Somebody told me that you can sign over the tax deductibility from the seller to the buyer. I don't know if that's true, but you might want to check into that. I don't think it would be required. I don't think it would be necessary. I've never heard it being necessary. It's an added benefit to the seller for that reason. What if the buyer doesn't pay? Well, what if the buyer doesn't pay in anything? You got the same options. You evict. What if the seller doesn't pay his mortgage? Well, we resolve that. We eliminate that problem and that horror story from ever happening by using a third-party trustee. The buyer will never make that payment to the seller in a lease option contract. In a rent, maybe, but not in a lease option contract. When controlling interest has changed hands, that buyer is going to make the payment to the third-party trustee, and the third-party trustee is going to make the payment to the underlying mortgages. They're bonded, they're a fiduciary, they're a trustee, and they're going to pay the taxes and the insurance when they come due as well, or potentially. Okay, so a third-party trustee will eliminate that. Again, on my video blog, you'll find recommendations from me as to where to go for a great third-party trustee. And typically these cost about $25 a month, and the buyer is very happy to pay that because they know and understand the value of not making that payment every month to the seller, worrying about the seller not making their mortgage payments. What if the seller has a bankruptcy? That's what title insurance is for. As long as you bought title insurance and you have the controlling interest of that property, controlling interest, not title, controlling interest of that property has transferred. Remember, title insurance does not insure the title, the name on title. The title insurance includes the ensures the cleanliness of the title and controlling interest of the title. So as long as you got the controlling interest in the lease option agreement prior to the bankruptcy of the seller, it makes no difference unless you did not exercise your option, didn't buy the property, and then the bankruptcy was still in play. Then the bankruptcy trustee would look at that as an asset to the seller versus the buyer. Okay? What if the buyer has a bankruptcy? Same thing. Okay, it's not their, they're not on title, but they do have an asset. So you would probably, as a buyer, I'm sure you would have to show that as an asset to your bankruptcy trustee, but you're not on title anywhere, so no one would find you on title. But still, legally, I'm sure, I don't know, you'd have to check with a real estate You'd have to check with a bankruptcy attorney, but I would assume because a lease option with equity in the real estate is an asset, that would be an asset that you would have to disclose to your bankruptcy trustee. What about homeowners insurance? Well, typically the title has not transferred, so the seller's insurance stays in place. Typically, I recommend that seller put the buyer on the insurance policy as additionally insured. That's a good idea, not necessary. I would switch to a landlord policy. That's okay. They may increase that insurance policy to include renter's insurance, all kinds of things that can be in the negotiation, or whatever they want to do there. What if the seller doesn't want to sell? Well, the seller has no choice. It's under contractual law. Check with your attorney on this, but it's an obligation for the seller to sell, not an option. The buyer has the option, the seller has an obligation. So the buyer would have the law on his side to go hire an attorney and make the seller sell if that was the case, okay? What if the buyer doesn't want to buy? That's an option. That's one of their benefits. They don't have to buy if they don't want to buy. Doesn't mean they have to lose their down payment. They could sell instead of buy. They could also sublease it and keep it. They could do a lot of things. The only thing they couldn't do is borrow money against it, which is another big value, by the way, over seller financing with an all-inclusive trust deed or a seller carried note and deed, because the buyer can't borrow money on that underlying transaction. That's another benefit that I just thought of as I was doing this presentation for the seller in a lease option contract. Do you have to set the price? No. The answer is no. Frankly, no. Frankly, though, yes, you should. The reason that is because the more moving parts you have, the harder it is to get the coming of the mind. So could you set the price to be like an equity share between the buyer and the seller later? Sure. Could you set the price to be a percentage of 3 different appraisals later? Sure. But you have more moving parts. That's a very big moving part too. So I always recommend setting the price. Something higher than it's worth today in an appraised value, but hopefully lower than what it might be worth when the buyer exercises their option. That's the whole idea here, is to set the value now. Biggest benefit to the buyer is they're building equity. They're setting the price now, okay? So understand that I recommend that you go in the direction of setting the price now, but you don't have to. There's all kinds of ways you can make a deal work. Does the buyer lose his down payment? Does the buyer lose his down payment? Does the buyer lose his? Of course he loses his down payment if he walks away. No different than in a mortgage transaction. Does he have to lose his down payment though? No, as long as the buyer's and seller's contract between the two agrees for or allows subleasing. The buyer could sublease it, the buyer could sell it, the buyer could walk away, but they don't get their down payment back unless they renegotiate that with the seller. But that's no different than any other transaction with a down payment. All right, so that's the end of the lease option program today. As a review, there's 2 closings: an opening of closing of escrow, buying title insurance, an opening and closing of escrow, buying title insurance when they exercise your option. Another word for it, another name for it, is buying subject to existing financing. Seller financing, no bank needed, another word for it. Title does not transfer during the lease option period, but does at the option when the option is exercised. And control of real estate is being transferred. The controlling interest of real estate is being transferred, and that's insured by the title insurance. A lease option is absolutely not the least of options. In fact, for many investors, a lease option is the best option and the one they use the most. So that's the end of that chapter. The next chapter, of course, is chapter 4, buying and selling, utilizing lease options.